I'm located in Mankato, Minnesota, where it's another beautiful, beautiful day. It looks like we're heading for 70s. So for mid-November, we'll take it, right? So nationally, November is recognized as Long-Term Care Awareness Month, and we here at Ascent feel very strongly about taking the time to, have a quality conversation around long-term care planning and how it might impact individuals and their retirement. So today we have Greg from One America. Greg is the regional director here in our area. One America and Greg have been really strong partners of ours. They offer kind of a different approach and with dealing with how to fund and prevent a long-term care event from really derailing your retirement. So with that, I'll turn it over to Greg, and he'll walk us through today's presentation that is going to, give us some ideas and educate us on, around the need for long-term care planning and how it might impact us in retirement. So, Greg.
Thank you, Ben. Appreciate it. I hope everyone's having a great day. So as Ben mentioned, my name is Greg Mance. I'm the regional director with One America. If you're not familiar with us at One America, we are a long-term care insurance company. We've been doing this for quite some time, since the 80s. So we were one of the longest running companies in this business. And I'm just going to share my screen quick while I chat here. Okay. And so, yeah, as Ben mentioned, I'm the regional director. I'm in the Twin Cities. I work with advisors like Ben and like Ann across the country. And really, I work with them and their clients to help set up plans for long-term care or for extended care. And so as we kind of go through this today, what I would just like to kind of share with everybody or reinforce, if there's one message that I want you to take away from our time today, it's that you have a plan for extended care. Whatever that plan looks like, make sure that you have a plan in place. I really want that to be the goal today, because when we look at the things that impact families financially and emotionally in retirement, long-term care or extended care it probably has the biggest impact on both of those things when we think about our later years. So again, whatever that plan looks like, it's just incredibly important that we have a plan. As we kind of get into this a little bit, what we're going to, again, want everybody to have a plan. I'm going to talk through kind of how, why it's so important. We'll talk through some of the statistics behind long-term care, share a little bit about what solutions look like as well. And then we'll open up for questions and answer Q&A at the end. So just to start us off, as I mentioned at One America, we've been doing this for a while. So we're based out of Indianapolis. We are a Midwestern company. We're a mutual company. That's really important. What that means is it means that we as a company are owned by our policyholders as opposed to being owned by shareholders. That's important because when tough decisions are made, a company like us, a mutual company, we make decisions based on our owners, which is our policyholders, our clients. We're also a very highly rated company. We have a Comdex score of 95 out of 100, which is higher than most of our competitors. And we, as mentioned, we've been doing this for a while. We were the first company to come up with the idea of asset-based long-term care and started selling it back in 1988. So we've been doing it for 35 years or so. We've got a lot of experience here. Just to get us started, maybe I'll just touch a little bit on what is long-term care exactly. I think a lot of times when I say the words long-term care, people think about a nursing home. That might be what you think of as well. And it is part of it, but it's not the entire story. So people are more likely to get care at home. I think most of us want to stay at home as long as we possibly can. So much so that there's even kind of a phrase that's popped up lately. You may have heard it. It's called aging in place, right? The whole idea is to make your home as comfortable as possible, to stay in it as long as possible. And so when we talk about long-term care, it's not just the nursing home, it's the ability to age in place. And really, it's defined as simply needing assistance with things that we can do today by ourselves. Those are what we call activities of daily living. So if you look on the screen, number 3 there, those different activities of daily living, there's 6 of them that we look at. And it's being able to bathe yourself, being able to eat, feed yourself, being able to dress yourself, transferring or moving between, let's say, a bed and a wheelchair, or a wheelchair and the toilet, or so on and so forth, using the toilet and being able to hold it until you need to use the toilet. Those are 6 things that all independent people should be able to do. And so as we get older, and I think this is a very good way to think about long-term care, is as we get older, we just simply need assistance with those things. The best case scenario is we're going to live a long life, and we're going to become, as we get older, we're going to need assistance. We're going to become more frail and need help with these things. So again, it doesn't necessarily mean that we're going to be in a nursing home, but it means that we'll need some assistance as we go. And that is, of course, the best case scenario, because it means that we're living a long life, right? What I'll maybe share here to just as well is, when we talk about care, what are the costs involved? Well, what I've got on the screen here, this is a tool that we put out at One America that shows the costs in different states. So if this is something you're interested in to learn more about, I know Ben and Ann would be certainly help get this in front of you. But let me just click on Minnesota, for instance. I assume most of us are probably in Minnesota. And I can click on this details page here, and it will show me what the costs are. So I know that I'm in the Twin Cities, so we'll maybe just look at the Twin Cities. I know Ben's down in Mankato, so you've got Mankato here as well. You can kind of dial this in depending on what area you're located in. So let's choose the Twin Cities, and I'm going to change this just to a monthly cost. And so what this is going to show me then is it shows me what the costs are for care where I'm located. So in the Twin Cities, we're looking at costs on average of about $7,000 a month, give or take, for home health care. And we're looking at a cost for a nursing home of close to $12,000 a month. So obviously those are when you extrapolate those and you do it annually, you're looking at upwards of $140,000, $150,000 a year possibly for a nursing home, and close to $85,000, $90,000 a year for home care, depending on where you're getting it. So if when we look at care, obviously it's a pretty expensive proposition. It doesn't matter necessarily the specifics. It's going to be something that's expensive, which again is why it's so important that we have some sort of plan in place. Whenever we do financial planning and we have something that is likely and has a high magnitude or a high expense like this, it's very important, again, that we have that plan in place. We can look at what the costs will be in the future. So if, many of us on the line here might be in our 50s or 60s. So, we probably won't need care until, we're into our 80s. So we're looking 20 years down the line. Well, if we look 20 years from now, this will show us what those costs are at that point. And they more or less get pretty close to doubling at that point. Home health care is up to about $13,000 a year, and the nursing home actually more than doubled over that time frame, where we're looking at $30,000 plus per month, right? Which again is a pretty large number. Well, that kind of leads me to another point. We talk about putting a plan in place, and we talk about kind of how do we pay for care if we need care. Well, if let's say that we need care and it's going to cost us, again, let's say we use today's numbers, say it's $13,000 a month. And we have to fill this gap if we need care somehow with our income. And so when we look at putting a plan in place, again, whether it's with insurance or not, we've got to get from $0 to $13,000 a month. The idea with insurance is what it allows us to do is it allows us to build a nice foundation. We can certainly put a policy in place that covers all of the costs of a nursing home, but it does tend to be a little more cost prohibitive. So generally, we're covering about half of those costs. On average, I would say most of the policies that we work with, we're looking at about $6,000 a month in long-term care benefits, the way the policy is set up. And kind of the whole idea with this is that, again, if we need to get to that $13,000 a month number, well, we've got a heck of a nice foundation already. So if we've got 6,000 in place, it's a lot easier to get from 6,000 to 13 than it is to get from 0 to 13, especially when you think about your retirement years where, you're going to have Social Security income every month. So that could be, another 2,000, let's say, or so. You're going to have, depending on your age, probably required minimum distributions or RMDs, which might be 2,000 to 3,000 or possibly more. You're going to have maybe a pension. You might have some other sources of guaranteed income. So again, it's not difficult necessarily to get to the 13,000 when you've got a really nice foundation in place. And that's kind of the whole idea with putting a coverage in place, is that we can build that foundation to help us get to that number. What I also like about this $6,000 a month number is, again, it's pretty affordable for most people. And also, if we need care at home, well, I kind of already showed you that the cost of care is somewhere around $6,000 to $7,000 in the Twin Cities. So if we start with 6, we've got most of that covered right now. So if we need care at home, we've got it covered. If we need care at a facility, we've got a really nice foundation that we can build upon. Regarding the future costs, well, as we talked about, we're looking somewhere, depending on how these numbers grow, around $33,000 a month 20 years from now. Well, again, that might seem like a scary number, but keep in mind that the reason this grows is because of the inflation of costs in a nursing home. Well, when we look at our assets, we have the ability to put inflation protection on our long-term care policy. We have the ability to put our Social Security income, rather, does have inflation protection built in. A lot of times our RMDs are going to grow as we get older, as our assets grow and the RMD amount becomes larger. And we'll have some, a lot of times have some inflation protection on our guaranteed income sources as well. So, it's that future number might seem large, but again, if we start and we deal with today's dollars and everything's set with inflation protection, it works out so that we can get there. But that's kind of the whole idea and the whole philosophy behind putting a plan in place, or at least a plan in place using an insurance policy. So let me just share with you some statistics behind the scenes here about when we talk about care, what does that really look like? Well, when we look at the averages for a male, on average, a male is going to need care for a little over 2 years. When we look at the averages for a female, it's going to be closer to 4 years. But I do want to point one thing out, and that's that these averages do have a lot of very short stays kind of built into them. So, somebody that needs care for, a couple months and then passes, unfortunately. Those aren't really, our typical long-term care scenarios anyway. So if we kind of throw those out and we just look at the averages with a more of a typical care situation, well, you're actually looking closer to 4 years for a male then, and closer to 5 years for a female. Why do I bring that up? Well, again, if we're talking about total costs and we know our monthly or our annual number, the average length of time is important to understand. So if we shouldn't be planning for a 2 to 4 year average, more like a 4 to 5 year, and that's today, of course, based on today's technology. It's likely that the length of claims will increase as time goes on. The other kind of wild card here is something like Alzheimer's. When we start to deal with degenerative diseases like Alzheimer's or dementia, those tend to be our longest duration claims. In fact, on average with Alzheimer's, we look at about 8 years in a typical case, which means, again, that's an average. So roughly 50% of people are longer than that. I can tell you, in my situation, my wife's grandmother had Alzheimer's, and she needed care in a facility for about 6 or 7 years, and she needed care at home for a couple years before that. So she was actually over that average. In fact, when we look at the longest duration of claims that we see in the industry, not to dig into these too much, but you'll see a lot of these. This is 7 different companies and our longest claims and our total cost involved. And you can see that a lot of these longer claims, are closer to 20 years, 15 years, so on and so forth. Again, just showing that, there's a very real chance that we could have a longer event like that. When we look at kind of where we see care going and the cost of care going, what are what are some of the facts or the trends that we see impacting things? Well, number one, the demand. We have the largest generation in history, the baby boomers, that are getting ready to, a lot of them are retired, most of them are retired at this point, but they're getting closer and they're inching closer to that age where people start to need care, which is age 80. That's kind of on average, 80 to 82 is where people generally start to need care most. And so the baby boomers are getting very, very close to that. So what it means is we've got the largest generation in history just inching closer to that line. A term that's kind of started to make the rounds recently is silver tsunami. And it just means we've got this huge wave of people that are going to start to need care. Well, of course, that means that demand is going to go up, and then of course will likely increase prices as well. I know where I am in the Twin Cities. I'm in the North Metro, and there's, I think, 3 facilities within just a couple square miles that are being built. And you probably see a lot of that where you are as well, where facilities are going up because of this oncoming demand that will be hitting very soon, if it's not here already. Number 2, we also expect people to live longer. So I mentioned that claims will likely increase in duration as we move forward. And that looks to be, as technology gets better, as we live with things we couldn't live with before, as we recover from things we couldn't recover from before, the longer lifespan will likely increase, and we'll see a longer duration, a longer need for care than we typically see today. So we expect that to, again, put more pressure on demand, which will, of course, increase prices as well. Family dynamics, this is a real big one. I think it's not talked about enough, but basically means that we don't have enough people or enough family members necessarily available like they used to be available to provide care, which means, again, that we'll need more professional service. So I'll give you an example of that. I'm from North Dakota myself originally. I'm from Bismarck. I live in the Twin Cities now, as I mentioned. So I moved 7 hours to the east. My sister's in Kalispell, Montana. She's 14 hours to the west. So, the two of us are not anywhere near home. And if my parents start to need care, we're not going to be there to provide that care for them. So that's a decision that will have to be made at that point. But that's also a very common thing that we're seeing across kind of the country as we start to see people move away from their home more and more, which of course again puts pressure on the supply and demand. And then I think the fourth trend just to be aware of is what the government and what programs are available for care. So we already talked a little bit about what the costs are for care. It surprises people a lot of times to understand that or to learn that there is no government program that allows you to keep your money and pays for long-term care. Okay, there's people are surprised a lot of time to learn that Medicare does not cover long-term care expenses. Medicare does not cover long-term care. There is a program available to cover long-term care expenses called Medicaid. Okay, Medicaid is aid. Medicare is care. It's medical. And so if somebody needs long-term care, Medicaid is the only program available. And the way that you qualify for Medicaid is you have to essentially spend your money. So if you have, let's say, $1 million of assets, there's nothing available to you until you spend your $1 million down to a really small bare minimum requirement amount. At that point, the government can then step in through Medicaid and provide assistance. But up until you get to that point, you're essentially on your own, and you have to spend your money. There's another phrase, if you're interested in learning about that, it's called Medicaid spend down, Medicaid spend down. And there's a lot of different strategies that people will use as well to, make that work as efficiently as possible. But at the end of the day, I always say, if you have to spend your dollars or spend all of your money to get care, it's not really the best plan. There's maybe a better way to do things. When we look at something like Alzheimer's, I think what's important to understand, I'll skip that graph. What's important to understand is that right now we've got a little over 6 million people with Alzheimer's. And in the next 20, 30 years, we expect that to more than double. And that's, again, just due to this silver tsunami, this oncoming wave of people that are going to be needing care in the next number of years here. Last statistic I'll share with you, and I think this is very, very important. It's the percent chance that someone will need care at some point during their lifetime. So right now, we have a 70%, or somebody 65 or older has a 70% chance of needing some sort of assistance throughout their lifetime. Now, that doesn't mean a nursing home, but it means that you're going to need some sort of assistance with care as we get older. But I think is an even more telling statistic is 70% of people, well, if you've got, husband and wife, a couple, 70% chance for this person, 70% chance for this person, what are the odds that one of the two of them is going to need care? I asked that question once during a presentation, and somebody said 140%. And I said, well, it's a good guess. It's not quite right. The math doesn't quite work out that way. But it's actually about a 91% chance that somebody in a couple is going to need care. So it's a very, very high likelihood of happening. And of course, we've already talked about the magnitude. So again, when we have something that has a very high likelihood and a high magnitude of impact, those are things that we absolutely need to plan for. So again, just reinforcing the fact that you need to have some sort of plan when it comes to long-term care, whatever that looks like. And so, if you do need care, here's a question for you. If you were to need care, how would it affect your family? Or maybe even a better way to ask that question, if you were to need care, who would provide that care? And my follow-up question to that would be, have you had that conversation with them? Whatever your answer is, have you guys talked about it? Because I find that most people haven't. They just haven't been proactive in putting that plan together. Again, hopefully this prompts you to go out and be proactive about those conversations, or be proactive about the situations and have that conversation. Really try to imagine what it might actually look like to provide care. What we see happen when people do provide care for their family members. Well, first and foremost, if somebody needs care, if it's a spouse or it's parent, people are going to provide the care. They're going to do it because they absolutely, they love the person that needs care. So it's going to be, they're going to care for that person regardless. What we see happen though is we've done lots of studies across the industry on the impact of providing care. And we see time and time again that it has a real detrimental impact on the health and the life of the person that has to provide the care. And so we see things like depression, the stress that is involved with it, that of course, it's poor sleep, blood pressure, weight gain, substance abuse. We see a lot of times as well. I think there's just a physical challenge as well. We might not realize how big of a difference that can make. You probably can't tell by looking at this, but I'm a pretty big guy. I'm 6'2", 260 pounds on a good day. There's not a chance that my wife, when she's 80 years old, will be able to provide care for me. It's just not going to happen. She won't be able to lift me or move me around. So there's a physical difference there. And then we have, of course, financial impacts as well. Things like, the decline in retirement assets, budget adjustments, having to provide additional care, those sorts of things. We also see a very similar impact on adult children. So with adult children, we see things like, all the same sorts of situations from a physical standpoint. But there's one additional aspect with adult children. And that's that, they have their own life, right? So if you have to provide care for mom and dad, and maybe some of us on the call have been through this process. I know we did with my own grandmother. But we start to see things like, the adult child have to take time off of work or put their career on hold possibly, definitely to provide care for a family member. It can provide, or it can put a lot of strain on their own relationships as well. So, it could put financial strain on them from not being able to work. But We can see just the marriage strain as well from spending so much time away from the family. And then it's also, not being able to go to kids' basketball games or football games or so on and so forth. So, I think for most of us, that's not something that we would want, a burden we'd want to put on our children. And that's the whole reason it's so important, again, to have some sort of plan in place. The other thing I'll just mention, and this, again, I don't think is talked about enough, and it's just the impact on siblings. Adult siblings don't always get along. We want them to, of course. It's always, it can be a strained relationship a lot of times. And then now you've got a situation where maybe one child is taking care of mom and dad or mom, where the other siblings are not. So you've got a strained relationship already, and you throw this huge monkey wrench into it. It can just make that situation just that much more tumultuous. So again, we want our children to get along. We want them to have a good relationship when we're gone. And of course, again, when you throw a big monkey wrench into things, those things are already strained, and it can become even more difficult. So here's a second question for everybody on the line, and that's that if you did need care and you got professional care, how would you pay for it? Right? That's I think a reasonable question to ask, especially since we've already looked at the costs involved. But when we look at the costs, there are really three ways that we can pay for it. Number one, we can use the government plan, which is the default, which is using Medicaid. Of course, as I mentioned, you have to spend your assets to get there. So again, if you've got to spend $1 million, is that really the best plan for you to have? Is there maybe a better way to use your money to protect against that? And even if you have, more assets than that, the question would be, how much of your money do you have to spend? Like that's something we just don't know, which was why I think it makes a lot of sense to look at some sort of insurance policy, which would be number two. Number three, just paying out of pocket. We call this self-funding. And it's an absolutely viable strategy. But again, I would ask that question, how much of your own money are you going to have to spend? And again, we just don't know. There may be more efficient ways to use your dollars to put something into place. When we look at insurance, I'd just like to share with you guys before we wrap up here, how do we put a plan in place, and what does insurance look like? Well, at One America, we offer something called asset-based LTC insurance. So asset-based long-term care insurance. And we call it asset-based because we start with an asset. That's really the whole idea, is that rather than just buying a policy that makes promises to make payments like a health insurance policy, we're actually buying an asset. And then what we do is we use that asset. It is your asset. We use that asset to create leverage for long-term care. I'll explain how that works in just a second. But the best part of this is if you never need care, it's your asset. So that asset is then passed on to your beneficiaries. And that asset can be either a life insurance policy or it can be an annuity. Either of those two things could work, and we have different solutions depending on what makes the most sense. But let me just kind of break it down exactly how this might work. So let's say that we have a life insurance policy as the base asset. We can also cover both husband and wife with one policy. So let's say that we had, let's just say two 65-year-olds. We had a 65-year-old husband and a 65-year-old wife. And we have them both on one policy. Let's say that we purchased a $200,000 life insurance policy. The way that this works then is if we need care, again, this is our asset, right? We have a $200,000 life insurance policy. So if we need care, we get to access this, and we get to access 2, 3, or 4% of the death benefit every month for care if we need it. Now, this 2, 3, or 4 is something that we choose up front. There are different advantages to using either of the different options. 3% is our most common, so we'll just use that. So let's say that we could get 3% of the death benefit every month if we needed care. Well, if you do the math at home, that equates to $6,000. per month, which is kind of, again, what we've already talked about. So we put this policy in place. It's got a $200,000 death benefit. So if we never need care, $200,000 is passed on to our beneficiaries. If we do need care, we have a $6,000 monthly benefit that we get to utilize for that care. What happens here is as we pay this long-term care benefit out, it actually reduces our death benefit. So after 1 month of care, if we got care $6,000 a month, we would then have $194,000 left in the death benefit because we paid $6,000 out already. If we got another month's worth of care, we'd have $188,000 left over. So you can see how we're utilizing this death benefit and leveraging this death benefit to provide long-term care. And you can see how over time that death benefit's going to go down. So we might get to a point where we actually exhaust this death benefit and there's no longer a death benefit left. That's not a bad thing because it means, A, we got leverage already by using the death benefit to pay for care. But there's a secondary feature here that I haven't talked about, and it's that we buy a rider. And what the rider does is the rider extends our coverage. So when the death benefit's gone, the rider kicks in and continues that $6,000 monthly benefit. We call this a continuation of benefits, or a COB, continuation of benefits rider. That makes sure, again, that $6,000 is paid every single month, even after the death benefit's gone. And we have options of how long we can set this up. Our most common option is a life, or lifetime rather. And what that means is it means that this $6,000 per month can be paid out for care as long as it's needed. There is no cap or no maximum amount of payment that can be made. So you can imagine a situation where you've got two spouses. Again, one spouse might need care for 5 years. Well, they have the $6,000 payment that goes the entire time. That spouse might pass away. The second spouse needs care. They still have an unlimited lifetime benefit that they can utilize. Each spouse, by the way, gets to utilize $6,000 themselves in this situation. So if they both were to need care, it would actually be $12,000 a month because it is a $6,000 per person monthly benefit. That's generally how asset-based long-term care policies work. Again, the whole idea is we start with this asset of $200,000. So if you need care, hey, we got $6,000 per month that can provide care for us. If we don't ever need care, we can get a death benefit that's passed on to our heirs so that we're getting something back. That asset is there for us. I'll just mention briefly, and then I'll kind of wrap it up and open up for questions. How do we pay for these? How could we pay for a policy? Well, we've got a lot of different options. We have the ability to use a life insurance policy that's already in existence. We can do what's called a 1035 exchange, where we take the cash value of one life insurance policy and we transfer it over into this specific contract. That's an option for us. We can use an existing annuity that you might have already. We can do the same thing, 1035 exchange of that money into an asset-based long-term care policy. We can do a lump sum, which means that we can just use cash that we might have available, cash or cash equivalents like a CD or a savings account to fund a policy. We can do annual payments if we choose. That's another option. So rather than making a lump sum payment, we just do a payment that lasts for 10 years or for 20 years or to age 95. We have a lot of different options there. A lot of different ways to do this. We can also use an IRA to fund this. We have got a process where we take an IRA that you might have, we do a transfer, and then use that IRA to fund our policy. It's a little more detailed. If that's something that applies to you, please reach out to Ben and Ann. We'll be happy to help you, put something in place like that, or you can learn more about it that way. But we've got a lot of different ways to fund these policies depending on what we're trying to accomplish. And really, it depends on which assets you have and how we could use those assets most efficiently to put something in place. So with that, I would like to kind of wrap us up here. And again, I would just like to go back to my opening statement. Again, the whole purpose of this was to help you understand why it's so important that we have a plan for long-term care. And hopefully I've done that today. And hopefully you can understand why it is so important for not only for you, but for your family members that we get something in place. So with that, Ben, I'll turn it back over to you.
No, that's no, really, really good presentation. I know it's timely with the again the aging demographic and just the need and the probability of a client needing to do some kind of planning around this topic. Many times clients, you either have the default plan, which you described in your presentation, you just go right to your balance sheet and start liquidating things, or you look into some planning, and myself, or we have team members in Wisconsin and Illinois to have these kinds of conversations with clients and just really, look to see if, again, maybe self-funding is the best thing for your situation. Maybe buying a policy is the best option, but how can we get creative to help, is it pure premium dollars out of pocket, or is it using another asset to help, make that plan affordable for clients and whatnot. So, but one question I'm going to ask you, Greg, I know we get this a lot when we talk about, the benefits that come out of these types of policies. What are the tax implications? Are they taxed? Are they tax free? How does that work?
Yeah, absolutely. I do want to apologize as well. I wasn't able to see my picture the whole time, and I see the sun snuck up on us. So I apologize about that if that was distracting. So Ben, you had asked about questions. I've kind of moved to the side here.
Sure.
You asked about taxes. So when we set up a policy, the taxes or the benefits that we pay are 100% tax free. So when we structure a long-term care contract, those payments don't hit your taxes. They won't affect your Medicare premiums. They won't affect your Social Security taxes. They have no impact on your taxes whatsoever. The terminology is a tax qualified long-term care policy, meaning that we don't have to pay taxes on the benefits. That's the whole point, and that's one of the reasons to use one of our asset-based policies.
Perfect. Great explanation on that. We get that question time and time again. And and I don't really see any other questions, but I do know, at least for our clients here in Minnesota, there is some updating or some upcoming potential tax mandates that might be on the horizon. Do you have a quick update on that, Greg?
Yeah, that's a very good question. So I think it's just important to mention, the state of Washington, just to go back a little bit, in 2020, the state of Washington actually put a law into effect that said that if you live in Washington and you don't have your own private long-term care policy, so it doesn't matter if you're Jeff Bezos and you're worth $50 billion, if you don't have your own private long-term care policy, they're going to put a tax in place on you as a citizen. So the only way to get out of this was to buy your own long-term care policy. That in Washington it's about $58 for every $100, or for every it's about 58 cents for every $100 that you make. So if you're Jeff Bezos, it's a lot of money, right?
Right.
But the point is, they put this in place. They were the only state to do that. There are a lot of other states really looking at this hard. Minnesota right now is one of those states. If you were to say maybe the top 3 states that are considering something, Minnesota's right at the list of those next, right at the top of the list of those next states to do something. So, we expect as an industry something to happen relatively soon in Minnesota. What does that mean? We don't know. Obviously, it's legislation. It can go either way, and there's a lot of things that affect that. But it is something that's being looked at very closely right now. So, good question, Ben.
And do you know, I mean, just we also have a lot of clients in Wisconsin and down through Illinois. Are they maybe on that short list as well too? I know just from our side conversations that it's sounding more imminent for Minnesota, but how about
Sure.
Wisconsin and Illinois?
Illinois, yes. Wisconsin, I don't think is nearly as far as Minnesota or Illinois. And Minnesota is much farther along than Illinois is, but Illinois is
Okay.
definitely in the list of states that are considering something.
Perfect.
What
It's
does
always
that
good to know.
what does that look like? Will it be an additional tax? We don't know. But it is something that the states are looking hard at.
Right. Always good to know what's happening today and what's on the horizon, what to prepare for. So, but well, perfect. Well, I appreciate Greg. I appreciate you taking some time to share this with us and all those that dialed in today. If there's anything that we can help with here at Ascent, feel free to reach out to myself, to Ann. My email address is ben@ascent.email. Ann's is Ann@ascent.email. And we'd be more than happy to talk through your situation and even tie in Greg to the conversation as well too, if needed. So really appreciate everyone's time and enjoy the rest of the week.
Thank you. Have a great day, everybody.
You bet. Take care.